Good morning. It is Tuesday, October 14th. I'm Zach Howard, morning market update. Back to a volatility regime that says you just can't buy anything. You had to be careful. Or is this just a brownian motion, episodic, and non-trending event stemming from the weekend events of the Trump family playing in the crypto market, or somebody was playing in the crypto market? Volatility has thus reared its ugly head here to the market gods. It can't be destroyed, created, nor destroyed. It is placed in a different place in the market. Now it comes back around to all markets when it appeared in that crypto space. Looking at a chart here from Tier 1 Alpha, where dealer positioning flips from positive to negative gamma in the U.S. equity index, S&P 500, roughly 6,650. S&P opens lower than that today, breaking 6,600. What does that mean? Negative gamma. Moves in the U.S. equity index move faster, both positively and negatively. Bigger moves. So we've had compressed volatility where the VIX has been less than 16, 17. So in that environment, it's impossible to get a daily move plus or minus greater than 1%. VIX greater than 20%. That's no longer the case. 1 to 1.5% moves will be the norm if this is sustainable, which we don't know. Short-dated equity volatility from a macro sense, no hedging currently put on. We don't have any data out there. Fed announcements, GDP, CPI, that really getting people to position for that short-term event on the counter. So potentially, if this volatility regime sustains itself here for a couple of days, you're going to see volatility positioning where those funds that just place capital, if volatility is low, they buy. If volatility expands, accelerates, they sell. We've seen that on Friday. Seen it a little bit yesterday. It's a 24 to 40-hour delay in their response to that actual event. The blue line there going above the red line, 1 month volatility spiking above 3 month volatility, risk off. That is when this selling begets more selling, especially in that negative gamma environment here. All-time highs, the market is vulnerable. What's backing it up besides those volatility regime? Well, we had corporate buybacks. Now that is a potential catalyst for higher equity prices. That is shut down short term here. 20 to 25 trillion in fiat market cap that can no longer currently buy back its own shares, which is a passive bid to the market. They're in a buyback window, blackout, until they report earnings. Financials reporting earnings today, so they can start buying back. But those big tech movers, they're on the sidelines. Inflationary assets, government inflation adjusted. Yeah, the BS government data. But what is gold saying? Gold continues to scream higher each and every week. It's crazy to bid into gold because of that physical demand is breaking paper markets. Paper markets can be manipulated until the paper demand gets overwhelmed, which we've seen in the silver space particularly. Where is the inflationary going? No doubt the tariff impact is going to get felt later on in Q4 and particularly in the Q1 and Q2 of 2026. But for today, you're looking at the price of oil, looking at the price of natural gas, both back to bearish trend, bond yields falling, gold catching a bid. If anything, to me, that's saying disinflationary pressures. Similar set when you line up with Bitcoin. Bitcoin loves the environment of inflation. Disinflation, not so much. I'm going to show you a chart here in a second, but another just something to keep an eye on when you see late stage exits like this from a legendary Howard Marks of Oaktree selling out his distressed dead brand of Oaktree to Brookfield. Selling out at the top, maybe just another marker there to keep in mind as this cycle gets late stage. Bitcoin to gold ratio breaking down hard here, 26. It was up as high as 38. This is an environment, and looking at this chart, which not a lot of people look at it every day, says disinflationary, especially when you line it up with bond yields falling like they are, 4.03 on the U.S. 10-year, gold screaming higher, even silver, which acts more like a precious metal in debasement times. That's saying disinflation. Disinflation here in the short term, which is going to be a challenge for risk assets. Risk assets do not do well in disinflationary environments, high beta trades do not do well. Well, we'll see. We will still see if this just is a short-term blip in the matrix, and we're back to all-time highs again later this week. But what is breaking those paper markets, as I talked about, the gold physical demand, especially when people have continuous to lose confidence in that paper US dollar, thus US Treasuries, how you express that view in the US dollar as it flees globally into gold and other hard assets. Central banks buying. Look at the Central Bank of Poland, Kazakhstan, China, obviously. Those numbers are way underreported. Turkey. We haven't even seen central banks of the legitimate big banks and legitimate sovereign countries start to accumulate gold at any stage here. The fear of missing out really starts to spark more buying of that hard money. Perth Mint in Australia suspends all silver sales as they cannot source demand. Another tailwind for that breaking of that paper derivatives market that is silver manipulation via JP Morgan and all those GIS banks, Barclays, Scotiabank, you name it over the years. They've all been charged with spoofing in the precious metals market, particularly silver. But now we're seeing lease rates in London silver market over 100%. The physical demand is breaking these paper manipulation games. It's nice to see finally. And if you're a silver or gold miner, you're just loving this action in the spot price accelerating higher as your biggest operating costs, your expense to your mine outside of your labor, being your energy, your diesel, your oil and gas component, especially in open pit, continues to fall. Boom, massive margins. Some of these margins for gold and silver miners, forget about your sales as a software, forget about your tech, forget about your semiconductor. The cash flow margins in this sector is smoking every other sector out there right now with this revenue minus expense model. That's what I got from the slide standpoint. Checking in on what we're looking at in currencies. The Japanese yen continues to fall. Like I say, the SPX is kind of recovering here off the open. VIX, see if it can stay around 22 is going to cause some short-term dysfunctions, particularly in those higher beta trades like Tesla. You're seeing the altcoins pull back hard here. Ethereum's pulled back. 4,000 regained a little bit. Bitcoin lost its bullish trend at 114. Does it tick down to 104? 102? There's a bit potential there. It ticked there on Friday night with that crypto liquidation. So we could see a touch of that again. If it ticks there, it's going to trade there. Jimmy Jude quote, long-time trader. But we got to respect the price action, and it's pulled back. And its last all-time high is down to 111 here today. Gold miners continue to rip. But like I say, to me, the biases in my notebook from a short-term trading standpoint, disinflation. Gold higher, precious metals higher, through platinum, palladium, silver. U.S. yields down, oil down, natural gas down, Bitcoin down. To me, that spells disinflation. Risk off for now. With that, see you soon.